particular topics you wanted to touch on? I was thinking the inflation one might be interesting.
Yeah, I think we're live right now. So I think the macro economic picture is what we agreed to start out with. And hi everyone, who's I think everyone's been kind of in the waiting room waiting, and we're just a few minutes late, but we're we're on live now, and I'm just retweeting it so people can see it at the same time. Anyway, in terms of inflation, what was your thought about that, Matt? You had some ideas to talk about with that.
Well, it's just been interesting. I think for a couple months now, a lot of the talking heads out there have been kind of concerned that inflation rates would continue to rise. I think when the concerns first started, I think the 10-year Treasury was around like 1.4%, something like that. Kind of crept up to 1.5, even over 1.6, but now it's fallen below 1.3. So it just, I think a couple months ago, if somebody would have told me that inflation rates would have fallen to 1.2, 1.3%, I would have assumed that all the growth stocks and maybe Tesla in particular, would be kind of soaring on that news. But I think the surprising thing, at least to me, is that it's been a little bit disjointed, the inflation rates from some of the growth stock names. So I find that curious, and it seems like that's maybe due for a correction at some point if these inflation rates stay low.
Yeah, I tweeted some macroeconomic podcast from a guy from Macquarie, Victor Shex, I think is the guy's name. He's written a book recently, actually ordered it because I was so impressed, and I listened to the podcast twice. But he talks a lot about inflation and disinflation, and that we're sort of in this pendulum swinging back and forth between the two, and probably for the next 10 or 20 years, and rates being above 5% will probably never happen again. And sort of what Japan has been doing is probably kind of the mode we're sort of in going forward with rates. And it seemed to make a lot of sense, everything he said. So it's a really interesting podcast. I tweeted it, a few days ago, if anyone's interested in seeing it or listening to it. But that's sort of what I think. Inflation, we're going to keep talking about it forever almost, because we're going to be sort of like on the cusp of inflation over and over and over again. It's never really going to come, I think, but it's just, there'll be very minimal inflation, if any, and that's just the way it's going to be. And that's my thought. What's more interesting about the kind of the macroeconomic picture right now is is sort of the nearer term stuff with the jitters, I think, in the market from this Delta variant scare. And I know a lot of people messaged me and direct messaged me on Twitter about it, and I don't get to all of them. I try to get to a lot of them, but just friends and family even ask about it. And do you think the Delta variant poses a big risk to the market, Matt? I know we've talked about it a couple of times privately, but what do you think?
Hey, I think you're right that it's probably giving the market some jitters right now. I think a lot of people had just kind of assumed we're done with COVID. We're gonna, kind of reopen and things will go back to the way they were for the most part, with maybe a few more people working from home than used to be the case. But it does seem that there's more kind of increased concern about this. My sense, and I could be wrong, and maybe there's different answers locally, but it seems unlikely to me that we'll have kind of widespread lockdowns again. It does I'm certainly no expert in microbiology or anything like that, but it does seem that this is transmitting more aggressively, but not necessarily that it's more deadly than the original variant. So the concern in my eyes, longer term, in the next 12 months, it's not necessarily the Delta variant, but as this thing continues to kind of mutate and evolve, is there going to be some variant down the road that's both highly transmissible and more deadly? I've heard a lot of stories of people who've caught the Delta variant, even know a couple people personally who've caught it, and it's anecdotal, but every single person I know of has just had a very minor kind of cold symptoms and nothing serious. Like we were concerned about back in March of last year with people in hospitals and people being overrun. So
no, I agree. I do think the media business model is going to run with it as best they possibly can. I mean, look, the clickbait is like to the extreme, like we've never seen it. So whether it's a Tesla crash or a fire, or it's some anecdotal story of someone who was double vaccinated and still died from the Delta variant. We're going to see these crazy anecdotal things pushed out to the public. Of the thousands of quote unquote experts out there on this virology, there's going to be some that are like off the wall screaming how dangerous the Delta variant is, and the media is going to really gravitate to that, because that's what our fear in the back of our, monkey brain mind gravitates towards the most scary things to look at, because we want to survive, in the wilderness and be aware of the most scary things. So we're just going to be drawn to clicking on, and the media is just going to put what we're drawn to click on, and it's going to seem scary. So I'm worried that that's going to cause like a little bit of a panic, and I could see 5 to 10% at most down move, short term in the next few weeks even. Potentially. I mean, I'm not sure enough to like put my money where my mouth is on that, and like put options at this point. They're probably, sort of expensive too, maybe for just a 5 or 10% correction. But maybe the market is due for that anyway, to some degree. And maybe we saw the beginning of it yesterday a little bit. And then on the flip side, with us at least, we're heavy on like Tesla and Roblox, for example. And those are both like, we saw yesterday, even though those were down early in the day, by the end of the day, they both finished positive, even though the Dow and S&P were both down like 2%. So the market's quickly adapting and adjusting to these like stay-at-home stocks. And Tesla's been sort of anointed a stay-at-home stock for whatever reason, but certainly Roblox, So we're sort of hedged in a nice way anyway. Yeah. We're hedged in a nice way in that we have, in our fund, at least several of these stocks that are known as the stay-at-home, winners or whatever, and we believe in them long term, obviously. So it's an interesting dynamic. Is it definitely going to go down 5 or 10%? I don't think it's definite. Maybe 50-50 in my opinion, just because the headlines are going to get out of control in the next few weeks, I think. But it's hard to pick.
So how would you contrast that with your thoughts last year when you actually did make kind of a big put bet? What would you say was your confidence level back then compared to 50-50 now?
Yeah, well, my confidence level then was much higher, and I thought it was going to be much more drastic, like a 20 or 30% drop. The market was at all-time highs, like it is now, sort of. But I was scared because of the unknowns that I had personally about this, and I thought that everyone sort of had, like even the people who could see through the noise. There was signal out there with. And citizen journalism reports in Italy and Iran and China, whatever. You could just zero in on certain instances where something seemed really off with this thing, something different, that we haven't seen before, that no one seems to be talking about as in the US, at least, as a major risk. I mean, some people, like conspiracy theorist type people, were thinking it's going to be out of control. And most conspiracy theory people are like, they're drowned out of the public square. But some smart conspiracy, Nassim Taleb, for example, and some others were like sounding the alarms too. And I just felt like this thing was going to get to the U.S. in a major way at some point, like it did in Italy and Iran, and started in China, and then a big city in the U.S. I just pictured with lots of deaths quickly, and the media going crazy with it would just cause massive panic. And I didn't know it was going to go down as far as it did. But I got out at the right time. Anyway, it just felt more like something unusual to me at the time. And I feel like we've been through this now already, so people sort of know what to expect. And I don't think it's as lethal this time. The deaths, that's the key metric, not how many people get this thing, but the number of daily deaths. That's really the key statistic I'll be watching.
Yeah, I agree. I mean, I think a lot of the media outlets too will use, scare tactics like, oh, it's, X% more transmissible. And, the single scariest factor or
Yes.
data point that they can,
That's the headline.
parrot, it's like, oh my gosh, it's 562% more, transmissible in.
Yeah, there's 2,000 times more, virus being shed. I've seen that.
In a study of 30 individuals, of a certain age group. So
yeah.
Well,
You
should
just
we
never
move
know.
on to
Yeah, let's
Tesla?
move on to the big draw. I think most people are watching us because they are very curious about Tesla and our views, and especially your analysis, Matt. So yeah, why don't we pull up, if you get a second, your screen, and we'll walk through your your earnings estimates and such.
All right. So I actually have two different Tesla models. Is that coming across now? Um, yeah. So I
I
have
see it.
kind of like a full blown discounted cash flow valuation model. Um, and I started using that for earnings estimates, but I actually found it had some issues just because there are a lot of differences between kind of the accounting, the GAAP accounting basis for financial statements versus, a cash-based valuation model. So I have used some of the inputs from that model in this model itself, but this is kind of a more stripped down, I would say more threadbare version. So what we have here is just kind of the last three historic quarters going across. Then in column L here, Q2 2021, that's what we'll be kind of focusing on as we go through here. So not, basically it starts off with a revenue build. So we have the actual deliveries for Model S and for Model 3 and Y down here. These are just from the Tesla delivery report. The first real assumption that we have is the full self-driving take rate. This is something that I've been really spending a lot of time trying to really understand. The take rate used to be around 27-30%, somewhere in that neighborhood. And it's actually just kind of steadily ticked down. So I'm estimating this because Tesla doesn't completely disclose it. But it does seem likely, given the fact that the China take rate they've disclosed is about 1%. So you just imagine as that, part of the pie of total deliveries for China expands, the take rate will naturally decrease, just as the kind of U.S. centric buyers become less of a percentage of the overall. But so then you can use that take rate assumption to get an estimate on deliveries, and then that creates a kind of a full self-driving cash intake revenue, which I get to right down here. So
one quick question, Matt. Well, one quick
yeah.
question. The take rate for full self-driving, do we know? I don't know if have you heard of the take rate in China? It's pretty low in China, right? And I think you referenced something about China. And do we think that
Yeah.
it'll go up quickly in China, or is this full self-drive? I don't know much about the full self-driving in China. What are have you looked at that much, or?
So they don't disclose much data. I think it was on the Q1 call that they disclosed the kind of in an offhand way that the take rate in China was only 1%. So
very low.
It's incredibly low.
Can only go up.
Which is,
can only go up.
Well, that's the thing. It's both bad. That not many people are buying it there, so it potentially suppresses gross margins there a little bit. And the other thing to keep in mind is that there are sort of cultural differences between the U.S. and China, specifically as it relates to software. There's I have a background in Chinese, for those who don't know, spent a decent amount of time over there. And there is, I think, a hesitation among many Chinese consumers to pay for software. People there generally just sort of think that software should come with hardware. And so maybe there are some pricing levers that Tesla can maybe change the way that it's packaged. Or maybe just it's simply just waiting for robo-taxis to roll out, or just to create so much value proposition that it really just drives take rate over there. But as it stands right now, there's just a huge fleet of kind of non-upgradable or non-upgraded customers. So that's one thing
do we think it's possible that the full self-driving just wasn't designed for Chinese roads very well yet, and it's just kind of really clunky over there compared to the U.S., and so people are like, it's junky, we're not buying it? Do you think that's possible, or have you seen any indication that it works fine over there like it does in the U.S.? I don't know. I'm just asking.
So there's certainly not, kind of the prevalence of YouTube, enthusiasts over there, at least that I've seen, I've looked. That kind of give the current state of FSD development in China. What I have heard just when I've looked through this is that it's clearly not as capable as it is in the United States. There are different traffic rules and regulations. There's just a lot of different things. And the other thing to keep in mind is that, city street driving in particular is just highly congested when you get into the big cities like, Beijing and Shanghai and a lot of the others. So you've got a lot of aggressive drivers. It's going to be harder, I think, to do it there. So I think the model that Tesla's following here is, basically get really good at solving, kind of US driving. Export the highway driving is fairly easy to do. So I think that, presumably works pretty well in China as it does in Europe. But essentially, I think they're going to need to have some kind of specialized local teams that help to kind of build up the capabilities. Once, Karpathy and his team kind of get the neural nets and the AI right, I think there's going to be an effort to kind of specialize in a lot of the local geographies, and that just hasn't happened yet.
Makes sense. All right, sorry to interrupt you. Keep going. Yeah.
No. But the thing that gets me excited about this, as excited as you can be about low take rates, is that Tesla continues to sell, this kind of cumulative group of vehicles, which does not have FSD, is continuing to upgrade. So this is something that I've tracked since I've started modeling Teslas. How big is that pool of customers that can actually upgrade to full self-driving? And right now, based on my best estimates, it's about 1.3 million vehicles worldwide that are capable of upgrading to Tesla or to full self-driving. So the other thing I've done is just said, okay, well, some non-zero percentage of those customers will upgrade every quarter. You see tweets about people who opt to upgrade for full self-driving. If that ever, let's just say for argument's sake that Tesla in the next 6 months really does solve full self-driving in the United States, and it's highly capable as kind of like a driver assistance feature, maybe not robo-taxi ready yet, but in a scenario like that, I could see kind of a one-time spike where instead of maybe 1% of people opting for an upgrade, maybe you get like a huge spike of 20% of the outstanding, and then you'd have like over 100,000 upgrades from kind of this huge pool. So you'd have potentially, you have the potential. I'm not saying it's going to happen, but you have the potential for a huge kind of gross margin boost on vehicles that have already been produced, and so won't be incurring additional costs. So this is I kind of view this as like the potential energy of Tesla's financials. They just have this huge amount of upgrade potential, and the thing that's exciting about subscriptions is that that's another way to kind of lessen the upfront commitment to try it out and to hopefully get more customers opting for that upgrade, because it's almost entirely pure margin for Tesla. So it's just the higher that number can get, it can have really drastic impacts on Tesla's financials. Sure. So that's something I'm really excited about, and I'll keep trying to kind of estimate going forward how far that they can drive that number up. But putting all that together, I have what I call a pure automotive revenue, which is essentially just the hardware revenue. So excluding, full self-driving, excluding credits, acceleration boost and autopilot, some of those, kind of software-based features. I think in order to really understand Tesla's margins, you need to isolate the hardware manufacturing piece of it and then add back in the software. So that's kind of what I've done here. I have here we look at the full self-driving assumptions here. So
hey, would you move your screen up just with our pictures? I think I'm blocking that bottom right.
Oh yes, all right.
That's all right.
Move it down here for you.
Yeah, thanks. Okay, go on.
So you have, based on the assumptions that we have about 430 million of cash coming in, but only about 42% of that is recognized or is deferred. So about half of the revenue coming in does not actually run through the income statement. It actually just builds up on the balance sheet. So looking at another kind of potential energy of Tesla, you've got $1.4 billion of deferred revenue recognition, or deferred full self-driving revenue. That's just sitting on Tesla's balance sheet. I know some analysts have assumed that a bit of that would be recognized this quarter. I think that's highly unlikely. Even though beta rolled out, the accounting of that is really, so I bought full self-driving, for example. So that $10,000 that I spent, is I still don't have any additional capability that's been delivered to my vehicle. So Tesla can't in Q2 recognize any incremental revenue from my sale when they haven't delivered to me individually that capability. So I think it's highly unlikely that we will have deferred revenue recognition in Q2, other than maybe some very small amount from a couple beta testers, which may have been added, which would really just be rounding error. But you've got $1.4 billion that I would say is likely to hit the financials in the next 12 months. I would say highly likely, maybe 6 months for a lot of the US, which is probably the lion's share of it, of this deferred revenue balance. And to other geographies, Europe and elsewhere, I would imagine in the next 18 months, this would all flow through to the bottom line. So this is really interesting to me because this $1.4 billion is from historical sales. So if you were to kind of add those back in, assuming that full self-driving was fully recognizable, it would have actually lifted the results, the financial results in previous periods. So instead, what's going to happen is you're going to have future periods be more profitable. And then on top of that, you're going to have 100% recognition in future periods whenever Tesla does deliver that functionality. So you'll have like a double whammy of really good gross margin news for Tesla in terms of recognition of deferred revenue, but also full recognition of new revenue.
Quick question, Matt. In terms of earnings per share, which is like the headline number a lot of times, like Tesla reported $1.95 earnings per share. So theoretically, if that 1.43 billion was released this quarter, which it's not, we're pretty sure, but we could be next quarter. But just theoretically, it was this quarter, and I think your estimate we're going to get to as soon as, like, what is it, 95 cents? We're going to get to that in a minute, but you previewed it.
It's Twitter. 99 cents. Yep.
99 cents. Okay. So if that 1.43 suddenly got recognized this quarter, how much would that add to it? Like a full dollar, or I don't know, what does it translate to?
You have to essentially tax affect it. The effective tax rate for Tesla is about 25%. So that would drop to roughly a little bit of mental math here, but about 1.1 billion. And then there's just over a billion shares outstanding. So yeah, you'd have slightly over $1 per share. Wow. That's just sitting here, and that will hit the financials in the next year or so. So this is the funny thing. Looking forward into 2022 numbers, I was looking at analyst estimates. I think the average estimate's about $4.45, something like that for 2022.
For the whole year. Wow.
For the whole year. And at the same time, the analysts are estimating 95 cents for 2021. So, I'm just doing some math. I'm like, all right, well, if you just assume, ignore Berlin, ignore Giga Texas, and just assume that, Tesla can repeat Q2 and, generate roughly $1 of earnings. Okay, that's $4. $1 per quarter is $4. Then you've got another $1 here from this deferred revenue recognition. So that's $5 already. And you've increased deliveries. You've not taken into account any of the gross margin improvement from, the structural battery pack or the higher margin, S and X that are going to be delivered. So it's just, I think 2022 is just shaping for a huge beat. And I think that it creates a lot of upward pressure because I think the PEG ratio in particular, it's close to falling under 1, which is, I think if it breaks that territory, then I think that would create some upward share pressure. So I don't mean to get way down into kind of these accounting details, but I think it is important to kind of model it out in this level of detail in order to see kind of what potential is coming down the quarter or coming down the road. So anyways, moving on. So taking that into account, you get $250 million of FSD revenue. I'm assuming a slight dip in the credit revenue because they did have that Stellantis deal, which dried up. It wouldn't surprise me if other automakers kind of stepped in to fill that void. So I think this is one area where maybe I'm a little bit conservative. It wouldn't surprise me if Tesla was over $500 million again in Q2, just like they were in Q1. But I didn't want to count on it given kind of that news on Stellantis. Then a couple other smaller items here, adding in some lease revenue, gets to total automotive revenue between these two of $9.7 billion. Then I've assumed
would you scroll?
Oh yeah, sorry, I keep doing that.
It's okay. Yeah, we're just getting used to this new format. That's all.
Yep. So I've assumed an increase in the energy revenue. Just kind of you saw in Q1 there was a huge dip. There were some pretty large mega pack deployments that went live this quarter. So I do think energy is likely to rebound, although I still have it kind of lower than it was in Q4. And then services tends to grow kind of in relation to the kind of cumulative automotive growth. So I'm assuming that gets up to just over 1 billion. So putting all that together, you got just $11.4 billion of revenue. So now this is where it gets really important from a gross margin perspective. So I was mentioning earlier that I want to look at the manufacturing margin of just the hardware and then kind of add in the software separately. So one of the other benefits of modeling out the FSD revenue is that I can then back that out from historical gross margins. So that's what I've done here, is kind of assumed, looking back at the historical levels of automotive gross margin, excluding credits and full self-driving. That gives you an actual gross margin of the manufacturing operations. So in Q3, it was 20.8. Then in Q4, we had that huge kind of surprise drop where it fell all the way down to 17.4. That was when they had a lot of those supply chain issues and kind of other unexpected impacts of COVID and just some of the raw material price increases that happened. So Q4 was a huge hit that nobody was really expecting. That recovered significantly in Q1 all the way to 20.4%. So for Q2, I'm assuming, with Model Y ramping up, that's a higher margin product, with Shanghai ramping up even more, and also just with, some of the price increases that we've seen. I think it's highly likely that we'll see kind of an increase in this metric in Q2. I've assumed it goes up, 0.9% to 21.3%, but that's another area where.
How many Model S Plaids did they sell again? Like 500 or 1,000? It wasn't that much to move the needle
it
too
was
much
like
on this.
2,000. Yeah.
Okay.
So it was about.
Could move the needle a little bit on that, maybe.
A little bit. I think it'll move it more in Q2 and Q3.
For
because,
sure.
The price increase on that is huge. And so 1,890 was the number. So
I wonder what the gross margin on those cars alone is. It's probably 40 or 50%, I would think, right? It's got to be pretty high.
I would think so. And, I would imagine almost all of those vehicles at that price point, people are going to be opting for FSD as well. So I'm sure your take rate on that is much higher. And I did hear somewhere, I think Elon said that the cost to manufacture these new Plaids was, comparable to the old Model S. So if that's true, then you're picking up an extra $50,000 in margin, just on the manufacture of those. So I don't know. You figure at 10,000 vehicles maybe in Q2, that's $50 million potential of incremental margin. Somewhere in that neighborhood. So I would expect this continues to ramp up over time, but that will be offset too with kind of the growing pains of the new plants coming online. Those will have lower margins to start. I think Shanghai was actually slightly negative for that first quarter, but it was on a very small kind of base of deployed cars or of manufactured cars. So anyways, putting all that together, you get total automotive gross margin. This is the way Tesla reports it. So Tesla doesn't report kind of this line up here. That's my own internal metric, but this is the reported line. So I'm expecting that will actually fall slightly to 26.1%, and the reason for that fall is primarily just the fact that you've got lower credit revenue. So media might spin that one way if I'm right, but I think the important thing to watch is kind of how that core manufacturing margin improves over time. So then moving on here, Tesla Energy saw really horrible profitability in Q1. They had a significant decrease in deployments of their energy storage products, and also had I think a lot of growing pains with Solar Roof. So I'm fairly certain they're losing money on every Solar Roof they sell right now, just while they try to figure out the best way to kind of manufacture and especially to install those. So I think it's going to take some time for them to figure that out. So I'm assuming just a 2% recovery from where they were in Q1 to get to negative 9.3%. So you actually have energy dragging on gross margins, and then services as well. Services it has historically run at a loss, so I don't expect that to change in Q2. I've just assumed the same level of profitability that they had in Q1. So putting all that together, 2.4.
Thank you.
Yeah, 2.4 billion of total gross profit, or 20.7%. I, interestingly, in Q1 historically, they've had the highest R&D expense. I'm not sure why that would be, but they actually have had, kind of a history of kind of high Q1 expense, which actually declines. So I have assumed a bit of a decrease in Q2 to 500 million, and then just an escalation in the SG&A. And I think we should be starting to see kind of a ticking down of the stock-based compensation expense, most of which is Elon's CEO award. I think that's going to start to come down, but it doesn't really matter anyways because it gets adjusted out for the adjusted EPS. So even if I'm wrong on that assumption, it doesn't really move the needle from what analysts expect. I'll skip over most of the rest of this because it's a little bit boring, except to note that I have assumed about $100 million of impairment expense related to Bitcoin, which is kind of netted out against some other income that they historically have here in the bottom line. But that gets to, if I can scroll up again here, 67 cents of, $670 million of GAAP net income, which is 59 cents of GAAP EPS, and then 99 cents of adjusted EPS. So that's kind of the high level model. Here's my kind of historic accuracy in doing this. I don't expect any sort of huge surprises here, but I think it's kind of interesting to look through this historically and just see how off Wall Street has been. So Wall Street consensus has been the number in red. My numbers are in green, and then the Tesla actuals are in black. So I think, I watch this so closely because I do think it does create kind of short-term opportunities when there are huge mismatches like we saw in Q4. And then again in Q2, when Fremont, Q2 2020, when Fremont was shut down, all the analysts just assumed, it's going to be, a total dumpster fire. But I went through and really thought through every line in high level of detail, and I thought, actually, you know what? I think they're going to do a lot better than Wall Street's thinking. And so you had this huge surprise kind of beat that most people weren't expecting. So I track this just to keep myself honest. I'm trying to give like a middle of the road estimate. And if I'm doing a good job of that, then I'll miss high sometimes and I'll miss low sometimes. And that's what I've done historically. So I'll continue to kind of track that and hopefully get reasonably close going forward.
Wow. Yeah, it's impressive, this chart here. I mean, this is the first time you and the street have been so close since Q4, but you guys are both wrong Q4 the wrong way. Hopefully not both wrong the wrong way this time. Yeah,
it's true. So Q4 was that huge, gross margin hit that nobody was expecting. That I think took everyone by surprise. Then in Q1, it was the street always kind of overemphasizes, I think, the last quarter and what happened. So you can kind of see here, like the street said, oh man, Q4 was terrible and Q1's historically more weak than Q1. Or sorry, Q1's more weak than Q4 historically, so it's got to be down from where the actuals were in Q4. But that's not the right way to think about it.
Yeah, the street consensus you're getting from like Bloomberg or FactSet or something like that, you think?
So, I don't have access to those, so I'm taking the most up-to-date Wall Street. Yahoo Finance posts the street consensus. So I take that for the chart historically. I've taken it from the day before the earnings are actually released, so that it's actually as accurate as possible. Typically, what's happened is that street consensus kind of gradually ticks up over time as we get closer to the release. But I'm not sure if there'll be a whole lot of movement this quarter.
I'd be curious to do like an analysis on the different participants in the street consensus. Whether it's like J.P. Morgan, Morgan Stanley. Strip out the outliers, and then kind of do a new street consensus minus the outliers and kind of see that, or just pick the ones that are close to being accurate as you perhaps on average and put them.
Well, somebody suggested doing like a Twitter consensus lately, and I actually think that's a great idea. Get like James Stevenson and Gary Black and myself and a couple of the other folks who've historically done this more accurately than Wall Street, and run this chart for those analysts. I think that might be a helpful way to do it. But anyway, I can stop sharing that now. But that's kind of where.
If you go back to the spreadsheet, I just want to see one thing. So the gross margin that you have at, I think, 20% or 20.1% or something like that on the spreadsheet. if you go to the spread, and right now you have 99 cents earnings per share. If you go to that spreadsheet and it's right now 21.3%, if you change it to like 23%, which is like sort of my optimistic hope, enter,
Yeah,
then that
with all the
changes the
bottom
earnings per
lines and
share at the
everything.
bottom. Yeah, if you go to the bottom, what does that change your earnings per share from 99 cents to
So
$1.09?
that'd
So
be
10
a
cents.
dollar nine. Yep.
Okay.
Yeah. So you could. I mean, if I were to go through this and say, so I tried to give a middle of the road case, like I said, but there's a couple things. If I were to change a couple things, to where we might be a little bit more optimistic, one would be maybe there's a slight amount of revenue recognition for full self-driving. So maybe we pick up $60 million there. I think that's possible, maybe just not likely. And then the credit revenue, I think it
Could be
wouldn't
a little
surprise me
higher.
if that actually grew a little bit because deliveries actually grew. So maybe we make that 550 million instead, assuming a little bit of sequential growth rather than quarter over quarter decline. I think those are the most reasonable changes I'd make on the upside. Energy could recover a little bit too, maybe to -7% or so. I don't think it'd be
Okay.
positive or even break even.
So it's like the most realistic, optimistic things.
Yeah,
So let's see what
things
that
where
changes.
it wouldn't surprise me if I actually was wrong on any one of those individually.
Maybe a
So
dollar
if
25.
$1.25 if we hit every single one of those. Now, I think it's unlikely that every single one of those will kind of move that way. But I do think every one of those changes that we just made is possible for sure.
Yes.
Okay. And I would say this quarter in particular, I think it's more likely that the numbers would be higher than 99 cents. Like, so we could have a 26-cent beat, to my numbers. I think that's more likely than there'd be, another gross margin deterioration and it'd be like 75 cents. I think it's highly unlikely that it would go the other way, just based on, higher deliveries and more Model Ys and that sort of thing.
Yeah, I would think some rumors would have gotten out by now of some kind of big drastic loss that we have to be ready for if there was going to be a big unexpected hit. I would think chip shortages. I haven't heard anything new about the chip shortages. I mean, I know that's still in play to some degree, but the only thing I can think of is maybe they have to pay double the price for the chips now, and that's a significant cost to their gross margins. I don't know, but who knows? Cost of materials going up, but they did increase the price of the Model Y multiple times, right? And that would offset that, or
presumably. The thing I always have trouble with when thinking about these issues, so like I was looking at charts of like aluminum pricing, for example, which is obviously a huge input into the the costs of these vehicles. But you never know when Tesla ordered that, what the price was. Maybe they actually have some long-term contract that's at some price. So that's on the cost side. Raw materials don't just magically hit the costs exactly in the calendar quarter. When the commodity price moves, and then at the same time, customer orders. So we're seeing like roughly a 3-month backlog for most vehicles right now. If you order today, you take delivery in October. So for that reason too, a lot of the price increases that they introduced in Q2, they may hit in Q3 rather than actual Q2 deliveries. I think that's another possibility. So if you were to extrapolate those in the worst possible scenario, maybe all the price increases will hit in Q3. So you got lower prices in Q2, but all the commodity price increases happened in Q2. So I don't really think that's going to happen either. And it's frankly, it's just so impossible to try to parse that out in any level of accuracy that I don't try. I just try to focus on that overall gross margin number.
Have you tried to put a spreadsheet yet together, similar, like a very early version for Q3 with like Troy Teslaike's estimate, I think he's got 220,000 estimate for Q3, but we think probably 10,000 of those at least will be the Model S long range and some plaids, right? But I wonder if you put that, maybe one of these weeks we can.
So here's,
I
would say I have not, I've not scrubbed this in the manner that I normally do, to kind of make sure that the numbers are right. But, right here, you can see I'm kind of assuming 230,000 deliveries and $1.10 in earnings per share. So I'm not at all saying that that's my estimate for Q3. I really want to go through and look at all these assumptions and kind of update them individually. But that seems, reasonable to me, given, what we know right now. But certainly that's not my published estimate for right now.
No. What's your Q4 thing? If you scroll over to the right a little bit on that line.
215, although that doesn't seem right.
Wow.
That seems too high. So
Okay.
I'd have to go through and scrub that
Okay,
a little
yeah,
bit.
you got to scrub those. Yeah, those are just very early. You haven't really gone into it
Yeah.
yet, but so maybe the Q4 you have to change that. But Q3 $1.10, and then you'll update that obviously a lot as you get more information from the Q2 report here.
Yeah, yeah. So I can see here I've got 294,000 deliveries. That seems too high to me just off the bat. So there's a couple things I need to scrub in here. I think the last time. So I have a separate model that I've been updating more frequently, like I was kind of saying at the beginning. So this is the first time in probably 5 months or so that I really scrubbed this model. So I still need
and
to do
the second model is just more
quarters.
detailed, or what's the difference with the second model?
Yeah,
it's just more complicated.
It's cash based, so it's used for discounted cash flow purposes, but it has a lot more granularity on especially on the revenue buildup. So I've got like a whole kind of lease buildup in here. And that's another one of the items that I'm really excited about too. Just quick side tangent, but Q2 of 2022 is when those first Model 3 leases will be coming up. So I know we're all so excited about how high used car prices are right now in general, and Teslas in particular. But starting in Q2 of next year, Tesla's going to be getting these cars back on lease, and they'll be able to turn right around and sell those, presumably
nice
at a very, very nice margin. So that'll be another kind of boost going forward.
Well, their original plan with that was they expected the full self-driving robotaxi network to be ready by then, so that they could just take them back and put them into the robotaxi network. I wonder if that's still kind of their timeline. Yeah.
I hope so. I mean, that would obviously be even better, but kind of like a worst case, they just sell them at, I don't know, 80% of new after having collected lease revenue for 4 years. I mean, that's like outstanding.
That's a great
for gross
deal
margins.
too. Yeah, great deal.
So
either way.
So that other model that I was talking about, it has a lot more detail on that level of buildup, but it also has full self-driving subscriptions baked into there, which I've not done on this model yet. And it has robotaxi assumptions, and then a very, very detailed Tesla energy buildup based on, kind of some things that I'm assuming around pricing for, VPP and some of their other products. So it's just a lot more granular, a lot more detailed, but harder to kind of translate into the earnings numbers that Tesla reports here.
Good. No, this is really impressive, Matt. Thanks for going over it with all of us. I know there's a lot of Tesla nerds and geeks out there like us that are, love this type of information. And you've been historically very accurate and well-informed on this stuff. And you got a good background in a lot of ways to help, generate this information with a high degree of veracity.
It started off as a hobby, and I just posted it to Twitter one day and started getting some people interested in it that way. So yeah, I'm glad it's useful, and I just I've enjoyed doing it. Not many people I think enjoy accounting and finance as much as I do. So I like to kind of share that strange passion of mine.
Yeah. So I think we have there's a guy who's really helping us. I hope people are okay with this production format. It seems to be going really well. But a guy, Alec Corum, we've kind of taken on as a junior analyst / intern. He's helping us behind the scenes put this new format together and get things a little better looking. But he's also going to help push out some questions. I know people have been asking a ton of questions. And so, Alec, if you don't mind, maybe you can display some questions Matt and I can go over. So I'll read the first one. Michael Fargo says, do you think they ever make a profit on solar, or is it a lost leader? I understand storage is profitable and VPP should be profitable.
Yeah. So
what do you think, Matt?
I think it will be. I think the main issue that I see right now for Tesla, particularly, it's on the solar roof. That's the product that on the solar side that they're prioritizing right now. But I think we've talked about this in previous live streams. But the problem with solar right now, with these solar roofs, is that you've got crews of 5 to 10 people spending weeks at a house. So the installation process is just not very streamlined right now. So I'm hopeful and I would say even confident that they get better at that over time. Elon even tweeted some housing company, I think in Wisconsin or something like that, that's really, I think, diving into this challenge head first and trying to figure out how they can install these more efficiently. The more exciting opportunity, I think, is to do these on new build homes where you don't have to tear off an old roof, and where the installation process is a little bit more predictable than it is on an existing home where you're replacing a roof. So I think that's going to be the biggest driver of solar profitability going forward is when you can actually have these kind of more standardized homes that you're installing on.
Yeah, I agree. I think that Tesla's core business is not hiring teams of labor folks to like go up on roofs and tear them down and hammer new roofs in. That's not really, to me, a core a core business Tesla needs to be in. I think if they could partner with other builders, like you said, and existing home remodelers, that'd be great. So, I invested in a small company called Sonderpods, for example, and they're building like small little houses, accessible dwelling units or ADUs in California, for example. And there's companies like that, or Boxable, maybe they could partner with. And I know people talk about Boxable, but companies that are building houses, like you said, that just come with the solar roof and you put it on as the roof for the new house being put in, right off the bat. So that would be ideal, I think, for Tesla.
It's cheaper because you don't have to tear off an old roof, and it just, the whole process would be smoother. So
it's a win for
I think that's the right way to do it, and I think we'll see more of those kind of pilot projects like we saw in Austin happen at a larger scale, hopefully going forward.
Yeah. Robert Schmidt says, question, at what point, if proven highly effective in improving highway safety, does full self-driving become mandated, like seatbelts and airbags? Yeah, I mean, I think Elon's talked about this, how in the future, driving yourself might be against the law. People will still go to the track and like drive themselves at the track, maybe. Just like people can ride their horses at certain places, but in the future, at some point, I think you got to get all these existing cars. It's going to be it could be 15 or 20 years away. I think in 5 years, everyone's going to all the new cars are going to come with full self-drive, maybe 7 years, but you'll have, whether it's Tesla, then you'll have companies like Comma AI, I think, becoming a bigger play, and all the non-Teslas, for example, and maybe some other car companies that develop a vision-based only approach that works, like Tesla and Comma AI. And I think pretty much all new cars, you'll want to have full self-driving in 5 or 7 years from now. And especially if you have kids or something, it's just going to be a no-brainer. The statistics will be there. There might even be like, maybe it'll be subsidized by the government. I think it's like good for the population to have less auto accidents and stuff. So, I could see it not being outlawed until another 5 or 10 years after that, though. But you have any thoughts, man?
Yeah, I think the same thing. I think it'll take some time. You're going to need other manufacturers, I think, to have it, because you're not going to outlaw something that Tesla has a monopoly on. So I think there does need to be some amount of, I would say, kind of competitive offerings out there, whether it's through Comma AI or other OEMs. But I think Tesla is probably going to be open to helping with that. I mean, especially once they get Dojo up and running, that's going to be highly optimized to solving this problem. And I wouldn't be surprised if once Tesla, marches down most of the nines that it needs to really get there, that they start kind of outsourcing that capability to the whatever software format that the other
it's true.
OEMs are pursuing. So yeah, I think it's probably at least a decade away before we see any sort of mandate like that. But it wouldn't surprise me if it's 10, 15 years away.
Mm-hmm. How will full self-driving affect auto insurance premiums? Will legacy insurance companies even insure cars with full self-driving, or will they have to insure with Tesla? That's a good question. I haven't really thought about have to insure with Tesla part. What do you think, man?
Yeah, I mean, so I use AAA for my insurance right now, and it's like I get the feeling from the pricing that I have from them. It's just like, we don't know what these cars are, so we're just going to overcharge you to make sure that we don't lose out. So their pricing is just so insane. It makes, you've got the safest car ever tested that I'm driving around, and it's like a significant premium to my wife's like Ford Expedition. I'm like, what? Yeah. What is the rationale for that? It makes no sense at all. I think eventually, as Tesla, I think it starts to drive down pricing just by offering it in more locations. I think it will certainly, if you're to look at the insurance cost on like $1 per mile driven, it will absolutely come down. I think where fleet operators potentially, or anyone who's going to operate robotaxis, needs to keep in mind that they'll be driving these vehicles a lot more frequently. So maybe your net cost even goes up, or maybe it stays the same, but you're driving 70,000 miles a year or something like that, or 50,000 miles a year. So I think cost per mile is probably the right metric to look at for that, but I do think it'll come down.
Yeah, and it also brings up a good point about Tesla insurance. I live in California. I haven't switched to Tesla insurance. I use USAA, but I could switch to Tesla insurance, I think, for maybe $50 a month savings, or maybe even a little more. But that could offset my full self-driving subscription package significantly if Tesla feels very confident in full self-driving in the coming months or a year, for example, where they're like, okay, anyone who's paying for full self-driving, if they're also using our insurance, it's a bundle and you get it for this amount. And then people can, almost offset a significant portion of the $199 per month cost just by using Tesla insurance too.
Yeah, I do think that's going to happen. I think there's going to be more of those kind of bundled products. But if you just look at the safety stats that they put out there, I mean, it's like the cost, it would be crazy for the cost not to come down. So I think it's just we're kind of still in this early-ish stage of these vehicles becoming mass market, that it'll just take some time, I think, for other players to lower prices.
P. Grennan 3 says, you mentioned last week you're selling Tesla June 23,000 puts. What is the probability you give that these get exercised? Do you view these being exercised as a favorable outcome? Well, I mean, I think no one's going to exercise these puts unless it's like a month or a couple months away from expiry. There's time value embedded you're losing if you exercise your options. If you have in the money call or put options, typically you wouldn't exercise them if there are still several months until expiry, just because you're losing you'd be better off just selling them to other market makers or whatever, because there's time value included in those options. So I'm not afraid of being assigned the options anytime in the next year or 18 months. It's possible, if Tesla's around $600 a share, come like April of 2023, that those 1,000 puts could be in line to get exercised or get assigned soon to me, and that wouldn't be the end of the world. We're prepared for that. If Tesla was below $500 a share, then it would be a losing trade, obviously, at that point, or whenever someone exercised it. So I'm not too worried about that, to be honest. But
I think the rationale for this trade, isn't that we think $1,000 is like the magic number, and Tesla's for sure going to be over that, by June of 2023. I think we're just looking at the probabilities, and I think there already is, like, I think it's something like a $50 time value premium on there right now, so it's not a huge amount, but that will slowly decay over time, and I think over the next 2 years, it's more likely than not that the price would rise rather than fall from here. So I think if we were to look at what's the odds that Tesla's at say $800 rather than $400, I think Emmett and I probably both feel that it's much more likely that Tesla's at $800 by that time than $400. So even if it doesn't reach the full strike price there, we can still close it out or take delivery, and we'll have a really nice gain from when we open these positions.
Yeah, it's almost a $90 time value right now. I think they're selling.
Okay.
They're trading. Yeah, the Tesla's at $650 the stock right now, and the 1,000 puts for June are trading at $445. So it's like a $95 time value, I think. And so it was like $110 time value when we did it, and now we've already collected a little bit of that time value. Yeah.
Which is just crazy to think, like, okay, so then I think, because when we put this trade on, it was like, say, 585. So in order to lose, Tesla would have had to be below like 485 by then. Which is just, we thought the odds of that were likely pretty low. And it doesn't, like we were saying, it doesn't have to go up to, $1,000 for us to make a decent return on it. So I think given where the market is right now, this is the trade I'm a big fan of.
Yeah, and the big I think thing that we like about it is the cost of capital to put the trade on. We're comfortable with in terms of margin is much less than holding the equivalent amount of shares per delta dollars of Tesla you have. So, it might cost you, $600 to own a share of Tesla, $650 to own a share of Tesla if you're not using it on margin. If you sell this call option, we only had to put aside like $200 that we were comfortable with, or $220, $250, something like that we were comfortable with. And so we could sell 2 of these call options and still have more than enough margin cushion that we were comfortable with for every share of Tesla. So we felt like we're able to maximize some of our capital exposure to Tesla for this time doing that.
Yep.
Brian Smith says, how much do you expect manufacturing innovations introduced at Giga Berlin, Giga Texas, and beyond, new paint shop, new battery manufacturing, Gigapress Cybertruck design to impact gross margin? I mean, I think there's a lot of unknowns here. Yeah, we don't know, and there's a lot of incredible skunk work stuff. I feel like every 2 quarters there's some crazy new thing they're revealing, whether it's the Gigapress or the Cybertruck exoskeleton, or there's just something crazy every 2 quarters no one's really expected yet, that is like, wow, Tesla's doing that, wow. So there's more of those to come, I'm sure of it. We just don't know what they are yet. Tesla's biggest and best and brightest engineers are working on that around the clock, and headed by Elon. What else do you want from a dream team, right? So I think there's going to be more of that to come, and that's exciting. But anyway, what were you going to say, Matt?
I was just going to add on that, I think a lot of these new efficiencies will probably result in price decreases rather than, simply gross margin increases. I think it's unrealistic to assume that, Tesla's going to be at, 2 million deliveries in a couple of years, and the average selling price will still be like, $55,000 or whatever it is now. So I think a lot of these innovations are going to be kind of required in order to drop the price point while still maintaining decent margins. So as I'm thinking about it, when I do my long-term modeling, I have prices continuing to decline. I think over 10 years, I get to the average price getting to about $28,000. Which is certainly aggressive. It wouldn't surprise me if they end up higher than that. But in order to be conservative, if you're going to assume that kind of huge increase in deliveries, I think you also need to assume that there will be pretty meaningful value delivery to customers. Just as an anecdote, my father-in-law was just looking to buy a car and really wanted a Tesla, but it was just $15,000 more than the next price vehicle that he was looking at. So, he ended up opting for a different one. But I think that if the vehicles were priced $10,000 lower, he absolutely it would have gone for the Tesla.
And so pretty soon they will be with the infrastructure bill. If that passes, that'll be incredible.
Yeah, exactly. So you'll have hopefully that credit, as well as just a lot of these innovations resulting in lower costs going forward. So I'm kind of thinking Tesla will hover around 30% gross margin, even while ASP decreases, but volumes will decrease or will drastically increase. So that's how I'm thinking through it.
Mark Patty says, what do you think will be a bigger deal for the Tesla 10 plus years out? Tesla Energy or Tesla AI/robotics? I mean, that's pretty broad. Tesla Energy and Tesla, I mean, they kind of go together. I think Tesla Energy is going to be a big deal, but that's going to be more commoditized over time. I feel like the batteries, Tesla has an advantage with batteries, but it seems like unless there's some incredible breakthrough that Tesla reinvents that, its suppliers don't piggyback off of easily, that the Tesla Energy will still grow, to be a huge amount of revenue, but I don't know if the margins will be there as much as Tesla's other offerings, AI and robotics. Like, I'm really excited about what I feel is inevitable as a supersonic EV, tall electric vertical takeoff and landing supersonic jet. I think that's the second half of this decade could be a big story. So there's lots of things like that. The robotics AI days coming up it's a big recruitment effort by Elon to get some of the top people. So it's just going to be fascinating to see what they come up with. And I don't think that's all new, very new stuff. And so I think they can have a wide margin lead on a lot of that stuff to have significant margins on those new products they come out with over time. But I don't know. What do you think, man?
Yeah, I agree. I've done some deep dives on Tesla Energy. If anyone wants to see those, you can go check out my old channel Spark Spread, where there's a Tesla Energy 101 and then a Tesla Energy as a Service. I've done some videos on these. I would say that the high level takeaway from me with my background in the energy industry is that these margins are very low. I think a lot lower than maybe a lot of the Tesla bulls would like to admit. And it's just going to take some time to kind of build up that scale where, a VPP can be meaningful to Tesla's bottom line. Because right now, even if you had 100% participation with all of the Tesla solar and power walls that are out there, it just wouldn't move the needle that much based on pricing available in the energy industry. And even if you wanted to do that, there's just so much bureaucracy with, different local regulations and utility industry is just very slow to move. So I think this is going to be a very slow, kind of shift that will just take, I think by 2040, it'll be more meaningful. But then I think my sense is by that time, whatever Tesla has up its sleeves with AI and robotics and, robo-taxis in particular, I think that's going to be more meaningful than what Tesla's done on the energy side from a financial perspective. But I think energy is going to be really critical from a mission perspective. And from a customer value perspective. I think one of the things most people don't realize is that charging your car from rooftop solar is like the cheapest way you could possibly run that vehicle. So I think it's going to be core to, as we were saying just a minute ago, kind of delivering that customer value to make the total ownership value proposition that much more compelling.
Yeah. Okay, Jackson K says, thoughts on the rumored split after earnings July 28th, with Elon hinting at a sequel, second 5-to-1 split ahead of Monster half 2021.
What was that hint? I remember something that seemed like a stretch to me, though. I don't recall exactly what that tweet was.
I think it was him changing his title or his name on Twitter to like Elon the Second or something like that. I thought maybe there was some other hint too, but people read into that like, hey, what's the second time around of a monster run up in Tesla earning? They can interpret it different ways. I do think a split actually is in the cards, because Elon, it's really his decision. I think ultimately, like if he asked the board, let's do a split, I think they would say, sure, let's do it. I think they trust him. He's the leader of that, captain of the ship of Tesla, and everyone knows that, no matter what corporate governance people think, or try to change it. I think that if his mindset is that he wants it to be affordable to retail shareholders more, which I do think is of value. He's a very principled person, and I think he wants Tesla shares to be affordable to the retail folks, because we've been a large part of Tesla from the beginning. And so if the shares are getting too expensive, maybe $600 to $1,000 feels a little too expensive to him for retail shareholders to buy a share. And I know there's like fractional shares available, but it's not the same. People aren't really as interested in buying fractional shares if they can buy a full share, right? And so if you can get that price point down to like $100 a share again or something like that, I think he's into it. Whether he does it this summer or next summer, I'm not sure, but I think it's in the cards, if I have to guess, just from knowing what I think I know about Elon and his mindset. So that's my thought. What do you think, man?
Yeah, it wouldn't surprise me. I would sort of think the price would need to go up a little bit, but there's no reason for that. And then the pure finance guy part of me just says stock splits are meaningless. Like they really shouldn't matter. But I think the fact is they do. Like we've seen time and again.
Just like stock prices should be meaningless. It should be market cap everyone looks at, but stock prices do affect people.
Yeah. It's great. There's a reason I haven't bought any Berkshire Hathaway Class A, because I don't
or Amazon. I haven't bought any Amazon on my personal account either. It's $4,000 a share or whatever, and I probably should have a long time ago. If it was $100 a share all this time, I might have dabbled in some Amazon from time to time, but I haven't because it's so much. I don't know why. Yeah, just subconsciously it affects us all.
Yeah. So I don't know. I'm not expecting it imminently, but I could be wrong. And who knows? Maybe he'll do what Rob Maurer suggested and make it a 69-for-1 split, like Rob had predicted that at the last one. It wouldn't surprise
Yeah,
me
yeah.
if he did something like that, just to kind of like,
69.242.
yeah,
69.42 for one split.
just to,
Yeah.
to kind of like rub in the finance world's face how stupid all this stuff is. Like, that seems like it matches his personality. So it wouldn't surprise me if there was something like that.
Yeah, yeah, yeah. Possible, for sure.
But if you were to do that, though, that'd be like $9 a share. So that's probably too low.
Yeah, yeah.
Should we do maybe one or two more?
Yeah, let's do two more questions. So JEKM says, what are your thoughts on Xpeng's new $24,000 car and how it will affect Tesla sales in China? I've heard something about this $24,000 car. Maybe it comes with self-driving or something. That seems a very low price point. I don't know when it comes out. I don't know enough about it to really opine on it. Xpeng, I think, could be a formidable competitor in China and maybe broadly around the world even later. But I don't know much about the $24,000 car. Do you?
I've seen it. I think it looks pretty great, actually. So I think that I do have some concerns about Chinese demand. I'm not panicking by any stretch, but I mean, just the fact that they're exporting so many cars to Europe, when if there was enough demand, presumably China would Tesla would sell directly to China. And I've been you can look at the wait times for a new Model 3 or Model Y in Shanghai, and it's just not nearly as long of a wait time as what you see in the U.S. So I'm mildly concerned about it, but I think it's the sort of thing that you need to kind of keep tracking over time. I think the whole market's going to continue to grow in China. And so what I think is going to be most important for Tesla is getting this new model out that they're designing in China. So I think that's really going to be a key metric, is just to see when can they actually launch that and what price point will it be at. Because I do think to really be a huge kind of volume player in China, I think they're going to need a compelling vehicle at a price point like $24,000. So I think Xpeng will do well with that if they can actually produce them at scale. That's a huge question, but yeah, I think it's something to keep an eye on for sure.
I also wonder if Xpeng or NIO behind the scenes has some kind of like assurances from the Chinese government, like, hey, we'll prop you up no matter what, to be as competitive as you can. So I don't know. That's partly in the cards, and so they can really gamble on getting. In the U.S., they might go bankrupt doing something like that, but in China, they know they're going to be propped up, as a backstop. I don't know. That's my thought as a possible factor.
Yeah, well, it's a way different market than the U.S., where lending and regulation and manufacturing are all like much more closely aligned than here in the U.S. So I think there definitely is some domestic favoritism there that could also be at play, but not only from the government, but also from consumers.
Yeah, and we have domestic favoritism here. It's not like a hit against China. We do it here. Every country does it. It's just we don't know exactly how China does it necessarily. It's not as transparent, maybe. So anyway, yeah, let's do the last question here. Let's see. Sagar Patel says, if Tesla wants to get into the utility business, why doesn't Tesla just build their own solar farms?
Absolutely not. I am 100% against this. So I was managing wind farms and worked closely with my old company's solar business that they were developing. And I really think owning and operating large scale, like utility scale solar farms, is not a profitable use of Tesla's capital. Returns on those, I think, optimistically are in like the 7% IRR levered, but then you need an entire team of people to kind of oversee them and do all the reporting that goes along with it. And that's just it's a very inefficient way to do things. I think that the future that Tesla is trying to pursue is this distributed solar and storage future, which makes a lot more sense, and I think allows Tesla to leverage their strengths. Also, with distributed solar, you have access to retail rates that you're offsetting. So a retail rate for a normal customer might be $125 a megawatt hour, 12 cents a kilowatt hour. And if you get into wholesale markets, prices are roughly 1/4 of that much. So just from the value proposition of solar, it's absolutely the highest when you're behind the meter. And so I think what Tesla's trying to do with distributed solar, get all the customers to pay for your hardware, get that spread, throughout the country, throughout California, everywhere you can. And then once you've done that, you haven't committed a bunch of capital into there because your customers paid for the hardware. Then you can aggregate them, use software to bid them into the market in an efficient way as a virtual power plant. I think that's a much more accretive, kind of value creative way to manage the business and manage their capital, rather than just going out and building solar farms, which I know from experience has a cap on your level of profitability. And has a very high O&M requirement that goes along with that, and regulatory requirements, and you need specialized knowledge, and it's not the way to do it, for sure.
Yeah, makes sense. Great. Well, this has been a nice hour here, and looking forward to doing this new format going forward. Seems to work smoothly, and hopefully we'll see all of you next week. We'll post this on YouTube, on our YouTube channel, and yeah, great chatting with you, Matt, and we'll talk soon.
Yeah, thanks, Emmett. Thanks, everyone. Thanks for watching.
Yeah, thanks, Alec, again. Okay.